Okay, well, we'll just get started here. So I know everyone's out and about here, and we've got a great call here planned for us. And, this is something that obviously we know that unless you've been living under a rock, you know what's going on with the coronavirus and how sensationalized this whole thing is, but it's really it's impacting the markets negatively now. And so there's a lot of fear out there. There's a lot of fear, not only of obviously the virus itself, but I think that the fear is about our retirement, our economy. There's a kind of a twofold thing here. And so what we thought would be a good idea today is to listen to people who are really in tune with the economy. And as far as the coronavirus goes, we're going to do what we need to do, right? Stay safe, okay? Wash your hands, do all the things we can control. And so that's that's I'm going to be as safe and healthy as I can be personally, and hopefully we all do those things. But as far as the economy goes, that's our business, is helping really calm fears. We have to be level-headed during a time like this, because a lot of people, especially when it comes to their money, they're very emotional, and that's everyone, right? And so our job as advisors and as financial educators is to help be a sounding board for our clients and for even people out there who we may come across as prospects. I think when there's a lot of high fear gauge and like this is where a book like, we're going to talk a little bit about this at the end, the How Money Works book, how you can really lay some fears to rest long term. A lot of why people are fearful, think about it. Most of the money, most of what's getting sold right now in the stock market is retail investors, people like you and me. They're the ones pushing the sell button. Institutional investors, they're not selling right now, and there's a reason for that. So we have to be a sounding board for our clients. The reason a lot of people are going crazy right now, selling so much and in the market, is they don't know, and they're worried and scared about the future. If we can provide some education around this to people, I think more people would be less fearful. And so anyway, Patrick, did you have anything? I'd like to just hear from your comments. Also, just, I know you've been talking to a lot of your clients, and just your thoughts on, what our actions should be right now. And then we're going to listen to this call from Brian Wesbury.
Sure. Yeah, thanks. Good intro there, Todd. Yeah. So I think most importantly at this time, as advisors, we need to be really just prudent about calling all our clients, like Todd said, and being just there for them. I can't tell you how many of them have just appreciated my call. We got to remember that, especially, this is when you earn your clients' trust, and they're going to remember that you were there for them when markets were down, and just talking them through it. Over 95% of my clients are not concerned by any means. One, because we've already restructured their portfolios in a way where this isn't affecting them all that much. And for the ones that have been going down their accounts, they understand it's long term, and a lot are looking to buy in. But the point is that you just have to call them. There's opportunity too. I mean, there's been several calls I made this week where people wanted to, do some more business. So, we can't be paralyzed by it, but we got to be proactive. And this is where we earn our income, is through these times. And, this is a different time for us. I mean, the last time we've gone through this was 2008, but a lot of us on this call who are maybe IARs and weren't managing people's money the way we are now, this is new to us. And it's a great learning experience. I mean, that's how you got to look at it. It's a great way to learn, and it's just going to make you a better advisor altogether. So I would just encourage you to just make the calls and just talk to them. And I think after you hear what Brian Wesbury is going to say here in a minute, it'll give you some nice talking points.
Yep. Yeah, and Brian Wesbury, he's a chief economist for First Trust Portfolios. He's worked with the Chicago Federal Reserve for a long time, over a couple decades, and so he's also been he's been a chief economist for representing with spoken to Congress many times. He's always on MSNBC. He's on Fox. He's on the news all the time. He's one of the number one listened to forecasters in the country. So just to give you a little idea of who he is, last 2 years he called where the Dow and the Dow and the S&P 500 would be within a couple days, pretty impressive. So he's someone who's got his finger on the pulse. This is the type of thing that we listen to so that we can understand no one can tell the future, but that we can be a calming sounding board to our clients. And guess what? If you don't have a lot of clients yet, some of you on the call, you're brand new, you're just getting started, whatever, just understand that you can bring, just with the How Money Works book at the end that Anthony's going to talk about, you could bring a lot of calm and peace to people as well. So we're going to get started with this, and just this, I think, would help a lot of people understand how to communicate with others. Here we go.
Today's conference is being recorded. At this time, I would like to turn this conference over to Marketing Director of First Trust Portfolios, Dan Affetto. Please go ahead, sir.
Good afternoon, and thank you for joining us today. Just a couple comments as we give everyone a few more seconds to dial in. The main responsibility of your First Trust wholesaling team is to bring the thoughts and ideas of our brightest minds to the advisors' desks. Many of you know that firms have canceled in-office meetings at least through March. The good news for you is you don't have to pretend like you're on the phone as wholesalers walk by your offices. The bad news is it's harder to get our thought leaders' commentary to you in these volatile times. We thought a series of conference calls would be the best way to share our firm's thoughts. Today, our chief economist will walk us through investing in a coronavirus world. The rest of the calls this week and next will take place at 10 a.m. Central. Tomorrow at 10 a.m., founder and CEO of Energy Income Partners, Jim Murchie, will be discussing the energy markets and oil's volatility. If you own EMLP, you know there's no one better to cover this topic. We will do the calls every day, at least through next week, but as long as there's demand from you. So please contact your First Trust wholesaler for the speaker lineup. Let's get started with today's call. The main objective of today's call is communication, both us with you, but also you with us. So with more than 5,000 lines filled already today and people are still dialing in, we're going to take questions either by submitting them through the email on your flyer or by tweeting it to Brian at Wesbury. We'll have about 15 minutes of comments. That's going to be the format for each of these conference calls, both today and then the 10 a.m. calls going forward, and then about 15 minutes of Q&A. So let's get to it. Most of you know that he was the Wall Street Journal's Economist of the Year. USA Today named him one of the nation's top 10 economists. MarketWatch and Bloomberg have ranked him as a top forecaster repeatedly, and advisors like yourselves throughout the country have ranked him as not only the most read, but the most shared economist. I'm going to turn it over to our chief economist, Mr. Brian Wesbury. Welcome.
Hey, thank you, Dan. Thank you very much. And thanks, everybody, for being on the call. I want to make this relatively brief. We already have a bunch of questions in queue, and I will get to those. Some of them I was going to cover already, but we will get to the questions that we are bringing in over the internet and your emails. So first of all, I just want to say that we can only work with the data that we have. I mean, we don't want fear and emotion to manage us. We want to work with the data we have, the models that we have, and the history that we have. And so I think if you just hear that, you're going to kind of get a sense of where I'm going to go. But I have a few points I want to make, and then get to your questions. So the first is this, that through February, all the way through the most recent week, we have seen no recession in the U.S. economy. In fact, it looks like the economy was accelerating in the early part of 2020 from where it was in 2019. We had 273,000 jobs. This never happens, but in both January and February, that's additional jobs in each of those months, the exact same number. The unemployment rate was down to 3.5%. Wages were growing at a 3% rate, and the latest number in February was 0.3, which if you annualize it, that's 3.6% growth. So this was a very strong job market. Retail sales were up 4.4% in January versus a year ago. Housing starts in December and January were the best 2 months back to back we've seen since 2007. The service sector is 84% of the U.S. economy, and the ISM service sector number in February jumped to 57.1. That's a true expansion. The manufacturing sector, which had been in the 40s during a lot of 2019, was 50.1 in February, and that's about 16% of the economy. So it's no wonder that the Atlanta Fed, which does a add 'em up GDP calculation every time we get a new piece of data, was forecasting 3.1% growth in the first quarter of 2020. Now that's pre-virus, and we fully understand that production from China it stopped and didn't flow to the United States. So as we get more data, we expect inventories to decline and pull that number down. So we're still looking for about a 2% growth rate in the first quarter of this year. So the whole point is we started this year and pre-virus very strong. The U.S. economy seemingly has no impediments to growth. Having said that, look, the virus is real. I don't know how else to say this. I'm not a doctor. I'm not an epidemiologist. I have talked to a lot of doctors. I have talked to epidemiologists. I have read hundreds of thousands of words that they have written. But I'm not trying to be a doctor here when I talk about this next section. It's real. People are dying. There is no doubt about that. It is spreading. But one thing to remember is this is our first social media virus. And I don't mean the social media caused it. I mean, everyone with a phone, everyone with an iPad, everyone with a computer can follow the cases that are happening and the deaths that are happening one by one every 15 minutes of the day or every 30 seconds of the day if they want to. And I like to look at this in one way to think about the 2009 swine flu. Nobody even remembers it, but we had 60 million cases and 12,000 deaths, and yet the economy continued to grow all the way through it. I don't think that's going to happen this time, and I'll talk about that in just a minute, because of the panic that is in the streets. However, when we look at China, and I'm going to tell you, their numbers, like, people worry about them lying, but the consequences of running a total disinformation campaign about this are tremendously bad for China. And as a result, I think they have an incentive. Early on, they were trying to hide it, but I think today they are not. But China's numbers have peaked and turned. It looks like South Korea and Japan, obviously two close neighbors to China, look to be getting slowly better as well. Now we know in Iran and in many places in Europe it's getting worse, but the bottom line is that we know the trajectory of this, and like every flu, like every virus, if you go back and look at the 1957, 58, 1968, 1969 flus, SARS, MERS, the 2009 swine flu, they all follow what's called Farr's law, and that is epidemics tend to spike higher and then peak and then come back down. Some people have been saying this is going to be like the 1918 Spanish flu, but I always try to remind everybody that was 102 years ago. Advil wasn't even invented until 1961, and already, because we've been able to map the genome, which was they didn't even know what a genome was in 1918. Moderna and other companies have, in fact, the head of the World Health Organization's infectious disease department said they set a land speed record because they've already pushed a vaccine into phase 1 trials, and it only took them 3 months. And so I'm not trying to be a doctor but every doctor I've talked to says that it's like the flu. It's way more deadly for older people and people with pre-existing medical conditions. But if you're under 50, the odds of dying from this are very close to the regular flu. So I think what we've done is panic about this. Right now, because of the panic, we are now estimating 0% growth in Q2. Now, it may be negative. If you go back to 1957-58 flu season, before we had social media, we did have 2 quarters of declining real GDP. And I'm not saying that that's impossible this time. But if you go back to that period, it was 2 quarters of declining GDP. We had tens of thousands of deaths back then, but we recovered in the next year very strongly. And we expect that this subsides in May, in June, in the weeks ahead, and that we expect growth in the 3rd quarter and 4th quarter. Now, that's important, in my opinion, because of what the panic has done to the stock market. And I'm going to we're roughly at 2,800 on the S&P 500 today. Roughly 2,800. Today was all over the place, but I'm going to use roughly 2,800. And you all know we have a capitalized profits model, which is how we measure the fair value of the S&P 500. And so if we went back and grabbed the 10-year interest rate from mid-February, the 10-year Treasury was at 1.6%. Now, the only reason I'm grabbing that rate is that was where we were before the panic hit, before a massive lowering of bond yields happened. And if we use that as our denominator, as our discount rate, and we use 3rd quarter last year's corporate profits, because we don't have the full 4th quarter in yet, what the market is saying today at 2,800 is that it is expecting a 51% decline in corporate profits. If we use a discount rate of 0.6%, the 10-year had fallen, well, it went into the 5s, 0.5s, but if we use a discount rate of 0.6%, it's looking, our models say that the market is pricing in a 79% decline in profits. And just to put this in perspective, in 2008, between the 4th quarter of 07 and the 1st quarter of 09. So in other words, the Great Recession, the worst economic crisis since the Great Depression, profits fell 46%. So right now, using our models, the U.S. stock market, the S&P 500, is pricing in somewhere between 50 and 80% decline in profit, which is both of those numbers are bigger than the 46% drop in profits during the 2008 Great Recession. Along with that, we had the biggest 2-week decline in 10-year Treasury yields ever in history. This isn't a perfect corollary, but the Cuban Missile Crisis didn't see anything even remotely close. And just as there are things that are happening. We're going to talk about oil next. Oil falling means gas prices go down. Well, this drop in 10-year yields means mortgage rates go down. And not only that, 10 years ago, the U.S. Treasury was issuing bonds at about with a 3.7% coupon, and now they can issue them at about a 0.7. And so there are a lot of financing costs for consumers, for business, for government that are going to come down significantly. So that's the positive side, if you will, of some of these market moves. But I just think that if you think about a 50 to 80% decline in profits, the market is pricing in just basically almost the end of the world. We don't know. They shut down Italy. We don't know if they're going to do that to the United States. We don't know if they're going to do it to Spain and Germany and France. So there are a lot of uncertainties out there, but I think we've priced in almost all of those bad events because 50 to 80% decline is Armageddon. The oil price decline, everybody knows what's happened. Saudi Arabia and Russia got into a fight. And by the way, without going into all the linkages here, this is all due to fracking. And what's fascinating about it is it's going to hurt those countries way more than it's going to hurt us. In the 2014 to 16 drop in oil prices, we saw oil prices fall 60%. Today, or this most recent decline, they fell about 48%. But back then, energy was 10.5% of the S&P 500. Today, it's 2.8% of the S&P 500. So the kind of hit to profits that we saw back in 2014-16, it's going to be 1/4 of that damage to today. We know that there are a lot of frackers that have weak balance sheets, but there are also a lot of energy companies that have very strong like bulletproof balance sheets. And so what's going to happen is that good balance sheet companies are going to be able to pick up the rigs, the leases, the fracking parts of other companies' businesses at lower prices. And it's exactly what we saw in 2014 to 16, where the consolidation actually brought down construction or drilling costs and made the break-even price, which today in the Permian Basin is roughly $31 a barrel. That's the break even, but that's going to move even lower because good balance sheet companies are going to be able to take over weak balance sheet companies at reduced prices, maybe not pennies on the dollar, but at very low price, and that's going to bring down the cost of production permanently because you're just buying assets at a lower value. And this is all good for the consumer because it's going to bring gas prices down. So what we're setting up with is lower interest rates, lower gas prices, and cheaper markets, which is going to allow an easier recovery once it happens. The final thing I want to say is this, and that is that the way I look at an economy, all right, taking the emotion out, taking the panic out, taking the virus out, because they tend to burn out over time, is we look at the fundamentals. And I've always looked at the 5 pillars of prosperity. And that is, number 1, Fed policy, number 2, tax policy, number 3, regulatory policy, number 4, spending, and then number 5, trade, like the Smoot-Hawley Tariff Act, if you will. And if you look at Fed policy, we've already cut 50 basis points. I do not think it was necessary. We're probably going to cut again, but the Fed was already easy, and now it's even easier. Tax policy, we have lower tax rates because of the corporate tax cut and the individual tax cut in 2018, and now we're talking about, and I wish we would do permanent tax relief for the economy, but the president today announced that he's looking to do a temporary payroll tax cut. He wants to go to 0 for both individuals and corporations. I don't know the odds of this going into law, but tax policy is better. So Fed policy is better, tax policy is better. Regulatory policy is better. We have continued to cut regulations. In fact, I saw the president today say that one of the things that they've done recently is reduce the regulations on the FDA so we could get testing kits out there faster. It wasn't, I'm trying, I don't want to be political necessarily. It wasn't the president's fault that these tests were delayed. It's the regulations on the FDA, the regulations on the CDC. That's the reason that these testing kits took a while to get out there. But now we've reduced those regulations. Spending, a infrastructure bill, it takes longer to spin up infrastructure spending than it does for a flu to spin down. So that is in my opinion, would be a ridiculous response to the virus. Now, sending some, I'm not a bailout guy, but it's like what we've done is we've forced ourselves and I wish the government wouldn't panic, but politics is politics, right? And so I would not be surprised to see direct subsidies to certain industries. And then finally, on the trade front, China signed phase 1. Mexico and Canada we have a new trade deal with them, and India and the U.S. are becoming closer on trade. So when I look at this, Fed policy, tax policy, regulatory policy, and trade policy are all positive. 4 out of the 5 pillars are positive, and that tells me that the long-run productive capacity of the United States will not be affected. We will make up for lost ground. Now, if you're an airline, if you're a cruise ship, people aren't going to take 2 trips instead of 1. So there's some permanent damage to their earnings. But over the next 3, 4, 5 years, if you look at the total earnings of U.S. corporations versus what they would have been without the coronavirus, my belief is that the difference will be very, very small. And that's why I'm looking for not only a rebound in the economy, eventually. I wish I could tell you it was going to happen tomorrow or next week or 3 weeks from now. It might take 6 or 8, might be until May. But the point I'm getting at is that panic creates opportunity. The market has priced in a massive decline in corporate earnings, which I think is way bigger than necessary. And as a result, I am not changing my forecast. As of today, we still have 3650 on the S&P 500 by the end of this year and 32,500 on the Dow. We're also looking for the 10-year to bounce back somewhere to between 1.5 and 1.75%. And the reason is that once these numbers start getting better, people are going to realize that the market way overdid this, that this was never going to be worse than the 2008 financial panic. And like we have seen so many times in the past, these things pass. And once they do, the economy goes back to its fundamentals. It was strong when we came into this. If you think about it, with lower interest rates and potentially lower tax rates, we could come out stronger than we went into it in the end. Plus, we're going to be doing catch up, not only in the economy, but also with stock prices as well. So I'm out of time here to talk. We do have some questions, and I can't wait to get to them. But I remain optimistic. I think the market is giving us opportunities to get into equities at values that just don't make sense given the reality that's on the ground. It's a panic, and that's opportunity. Thank you very much.